Hi everyone. We've dealt with the concepts under Ind AS 37, which is provisions, contingent liabilities, and contingent assets. It's time for us to apply those concepts with the help of some questions to test our knowledge. We are provided with this scenario. It says that during the year 2018-19, X Limited, which is involved in nuclear activities, recognizes a provision for decommissioning costs of 15 crore rupees. The provision is based on an assumption that decommissioning will take place in 80 years' time. However, there's a possibility that it will not take place until 120 years' time, in which case the present value of the cost will be significantly reduced. Assume that the discount rate of 2% is relevant for X Limited. Discount factor at 2% for 40 years is 0.4529. Questions requirement suggests you are required to draft a note for X Limited. Now, there is a change as you observe that what you originally assumed that you're going to incur some costs of decommissioning in 80 years of time, it has increased by 40 years, right? It is expected now that it will be only taking place after 120 years now. Okay, so when you look at this scenario, of course, you have been recognizing the cost at 15 crore rupees. That cost, the present value of the cost, because the time is delayed by 40 years, the present value of the cost will reduce, and this would automatically reduce your provision amount as well. Okay, that's a fundamental concept. Of course, the requirement is to prepare a disclosure note, for these changes in the assumptions of the estimates as we see here. Okay, now we are also provided, of course, that the discount rate which is relevant for X Limited is 2%, and the present value factor is also provided. So the one calculation that we need to take into consideration, this is going to be the reduction in the, this is going to be the reduced value of the provision, because while 15 crores is taken for 80 years, it has to be assessed for 120. So naturally the value would be reduced further. So when you look at this, let's say, calculation, this is, let's use a calculator here. This comes at 6.8 crores approximately. We are good to use that figure in this, calculation. So what are we saying now? Okay. So when you look at preparation of the disclosure note, we say that X Limited is required to incur a decommissioning cost originally expected. Of course, you are allowed to use your own wording. The whole idea is to explain what has happened and what is the consequence of that change, right? Originally expected to be incurred in or after 80 years, right? The change in circumstances would now require X Limited to incur these costs after 120 years, right? Accordingly, the existing provision of 15 crores, which is based on current estimates, the existing provision of 15 crores, which is based on current estimates, will be reduced to 6.8 crores due to the above change. That's precisely what is the disclosure requirement under Ind AS 37 for this particular scenario. All right. Let's have a look at the formal solution. It says that a provision for decommissioning costs has been recognized for 15 crores. These costs are expected to be incurred in 80 years. However, there's a possibility, there's a likelihood that decommissioning will not take place until 120 years. Now, if the costs were measured based on the new expectation, the provision would be reduced to 6.8 crores, discounted using a discount rate of 2%. So the discount rate mentioned is also important in that case. So we need to highlight that part also, right? The working, of course, 6.8 crores is calculated as this, the provision after discounting for additional 40 years, which is 120 minus 80, is 15 crores into that discount factor, 0.4589. That results into the value of 6.8 crores. All right. Let's have a look at this scenario. It says that Good Wash Limited, a washing machines dealer, offers to its customers a scheme whereby it offers to buy back the washing machine at a fixed price after a period of 4 years. The fixed price is expected to be less than the fair value of the washing machine at the end of 4 years. The credit provided to the customers will be required to be used for buying a new washing machine. That is, new washing machine will be sold at a discounted price. Past experience indicates that customers generally opt for this scheme. The question is, you are required to determine whether Good Wash Limited should recognize any provision at the time of sale of first washing machine to its customers. Now, what do you need to remember here? The moment the question asks you to assess whether a provision is required, the first thing that you want to bring, the first thing that you want to highlight is that when do you actually recognize a provision, right? So those recognition criteria need to be provided, need to be given as a part of your solution, right? So we may say an entity recognizes a provision when it has a present obligation, right? There is expected future outflow of resources and the amount can be reliably estimated. An entity recognizes a provision when all these criteria, present obligation, future outflow, and reliable estimate, they are met. Okay. So in this given scenario, is there a present obligation? Is there an expected future of outflow of resources? And whether the amount can be reliably estimated are these tests that we need to kind of conduct. Okay. Now, by virtue of the contract, of the sale contract, Good Wash Limited is obliged to take back the old washing machines, right? Of course, the option lies with the customer, but then of course from Good Wash Limited's perspective, this option is not there. They are necessarily obliged to take those old washing machines back, right? So which suggests that there is a present obligation, right? Of course, the machines are purchased back at a discounted price. Okay, so you expect future outflow of resources as well. And finally, when you look at the third category, that historical data suggests that, right, the customers usually opt for the scheme. Now that would determine, that would suggest that the reliable estimate can be done for such buyback or a repurchase, right? So considering all these factors, we can safely assume that three parameters or the three conditions are met, which actually means that hence Good Wash Limited is required to create a provision for the repurchase, whatever costs or repurchase costs of the washing machines. All right, that's how you start explaining the concept, and that's what is the expectation of the examiner as well. So be very clear about what is the examination asking you to do, and of course explain that well. All right, let's have a look at the formal solution. It says that a provision shall be recognized when there is a present obligation, outflow of resources probable, and reliable estimate can be made. Okay, if in case these conditions are not met, any of these conditions, then you cannot recognize the provision. Okay, now essentially, when you're recognizing the entire revenue, for example, the provision of expected cost is there. So there's a present obligation and a past event, of course. Similarly, people opt for the scheme, so the probability of outflow of resources and a reliable estimate can also be made, which simply means that, of course, we are required to create this provision by this company. Okay, let's have a look at this scenario now. It's quite a long question, but let's read it together. It says that during the financial year 2018-19, the income tax authorities send a scrutiny assessment notice to Mark Limited, which is operating in the software industry. The notice is issued under Section 143(2) of the Income Tax Act with respect to the return filed under Section 139 of the Act for the previous year 17-18, of course, assessment year 2018-19, and initiated assessment proceedings on account of a deduction which in the view of the authorities was inadmissible and claimed by the company in the filed return. Now, during FY 2018-19, the assessment proceedings were completed and the assessing officer did not allow the deduction and raised a demand of 5 crores. So very clearly, there is a deduction that the company has claimed. The income tax authority or the assessing officer is simply disallowing that. Okay, the company contested such levy and filed an appeal with the appellate authority. At the end of 2018-19, it is still pending to be heard. Now, from the company's perspective, it's mentioned that company is not confident on winning the appeal. However, the legal counsel has advised the company that on similar matters, two different authorities or two appellate authorities of different jurisdictions have given conflicting judgments, one in the favor of the SSE and one against the SSE, right? The legal counsel further stated that it has more than 50% chance of winning the appeal. Okay, you're required to advise how Mark Limited should account for this transaction in FY 2018-19. Now, importantly, when you look at this scenario, again, the concept or the recognition principle of provisions, right? When should a provision be recognized, right? You need to again bring those perspectives. There is a present obligation, there's an expected outflow, and then of course the reliable estimate can be made. Now, in this given scenario, what you need to observe, let's have a look at the scenario once again. What you need to observe is that There is a demand of 5 crores. So in a way, amount is known, right? So the reasonable certainty part, or the measurement criteria of that provision can be identified, right? Similarly, it says that there is a present obligation in the sense that there is a notice which has already been served, okay, and the demand has been, of course, claimed by the tax authorities. All right, so that is where you start looking at there's likely present obligation. We're not saying that it is necessarily a present obligation. We want to add that factor that the company is not confident on winning the appeal, and there are different judgments made, for example, in such kinds of cases. Okay, so when you assess this parameter, right, from a present obligations perspective, the likelihood of winning or losing the case is uncertain, right? So you need to bring in the expert's opinion, the legal counsel opinion, or the legal expert's opinion, etc., and to arrive at such kind of the possibility of what is the probability of winning or losing. But again, since the fact suggests that the company is not confident, and there have been instances where it can either go in favor or can go against, as far as the company Mark Limited is concerned, the case can go either in favor or against Mark Limited. So even that uncertainties exist, which probably suggests that there is both a present obligation and expected future outflow. Okay, so you need to be a bit more, so you look at it in a bit more prudent way, where you see that if that uncertainty exists, the probability is more likely than not that you would lose this case, right? So there's a probability of more likely than not that you're not going to win the case, and accordingly, it would be prudent for Mark Limited to, of course, create a provision in this particular scenario. All right, so that's how you start looking at that these parameters: the present obligation, expected future outflow, and reliable estimate. When you are able to make these, clarify that with respect to the given scenario, you are in a good position to be able to address this particular requirement. Okay, let's have a look at the formal solution. It says that in rare cases where it is not clear whether there is a present obligation because there is a dispute, in such a case whether there a present obligation exists, now the company is not confident, and accordingly, after taking the opinion of the legal counsel as well, it is not very sure whether they would win the case, right? So accordingly, it is more likely than not that the present obligation exists. There's an expected future outflow, and the reliable estimate of that amount can be made, which actually suggests that Mark Limited should be recognizing a provision of 5 crores in its financial statement for the year ended 2018. All right. Thank you very much.